Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host, and today's guest is Jerry Fetta. He's the CEO and founder of Wealth DynamX. Jerry's a published author, successful entrepreneur, investor, and nationally recognized financial expert featured in Forbes, Fox News, and New York Finance, earning endorsements and affiliations throughout his career with names like Grant Cardone, Ramsey, and Pamela Yellen. Jerry, thanks for being on the show today.
Yeah, thank you, Cliff. I'm excited to be on. Thanks for having me.
That's a privilege. Tell us about your background and how you ended up in finance.
Yeah, so I am 30 now. I got in the financial services industry at 18. It was really kind of like, blindsided. It was never something I thought I would do. Growing up, I don't think any little kid is like, I'm going to be in finance when I get older, maybe other than Warren Buffett, right? But I was doing, personal training. I was a bodybuilder. I went about as far as I could with that at a very young age. And I had a friend that approached me, was like, hey, you should look into doing, financial advising. And that's kind of where I got in. I was very attracted with the ability to help people. I saw a lot of parallels between that and, physical health, spending more than you earn, similar to me, eating less calories than you burn, that type of thing. There's a lot of personal behaviors, disciplines, just truisms that kind of resounded. So I got licensed, I got in the industry, and that's kind of where I got started. And it really has evolved over the last 10, 11 years or so. From a very, what I would call retail standpoint, stocks, bonds, 401ks, those types of things, to really starting to specialize more in the alternative space, working more with real assets, doing more of the top 1% strategies and things of that nature.
That's important work. You had a foundation of learning. You got your licensing, which is very, very positive. And at that point, you saw the light. There's a lot more to the industry.
Yeah, it took a couple of years, but I did see it, and I was thankful that I did.
Okay. What specifically drew you to helping others become financially educated?
My mom and dad got divorced, actually from each other several times, and it was always over finances. Okay. When I was 9 years old, this was all in the same summer. We lost our house, we lost our car. Parents got divorced. We were homeless. There was a bunch of just, crazy financial related stuff. And so, as a kid, that was a big ruin for me. It was like a topic. It was a sore spot. I was like, I'm not interested in finances. I'm not interested in money. And then as I started getting older, I started realizing it's not really an option. You're involuntarily in the financial system, whether you like that or not. We've got to have incomes. There's, investing, there's banks, there's inflation, there's taxes, there's debt, there's all this stuff that we're going to interact with. And I started to realize my parents were just never trained on it. Same thing if you put a kid in a car and never teach him how to drive, you can't be surprised when he gets in a wreck at some point. So, I was able to see that and see the solution of being able to help and teach and, give people the information that we should be taught in school. We're not. And things that if I would have had, it probably would have been easier for me to understand and also succeed, from a financial standpoint much sooner. So that was really what attracted me to it. I've always been a numbers guy as well. So I like math. I like, I'm not one of those where I can do it all in my head. I do need the calculator, right? But, the flow of things and seeing the math work and seeing problems be solved really is what got me into it and made me interested in helping others.
I want to compliment you. You brought something up really, really important, which was what education looks like here in the U.S. And this program is listened to on a global level. So global, I get feedback from Germany, Singapore, the Philippines, Australia. So, so I'm hoping over time, education inside the high schools, even in the grade schools, and then going into the universities will include the financial. And then the other side of it is, what is it being a mom and a dad? In other words, anyone to have a child, but the idea of being a fabulous mother and a fabulous dad and involved with your children is something that's very vibrant. So the financial education plus the other side on the social side probably would strengthen, the foundation of what a family is and allow you felt it firsthand as a young person where when the finances aren't working right, it creates that uproar or dysfunction in the family. So we really have a fiduciary responsibility in the educational program to bring in the skill sets that you're kind enough and you're sharing with the community at a much earlier level at this point. So,
Yeah, totally. And I think the statistic on marriages, I believe 60% of them do end in divorce. The number one cause is finances. So it's right there in the numbers.
And our listeners are usually very high and ultra high net worth individuals. There's different stresses that come into that particular field, but still, money comes up, frequently for the next gen. How do we look at the children and figure out what education they need to be able to flourish as individuals? And then also, we have a legacy sitting here. There's a great deal of wealth in the family that needs to get managed. So, partnering with people like yourself and some of my other, guests will allow those young people to be able to take some assets from the family and be able to put them to work and get educated firsthand and get the positive feedback from mom and dad, on the growth of those assets. So, I'm trying to suggest to our listeners, yes, you need to go out and you need to find the advisors that you can work with that will also spend quality time with your children and help them bring their skills up and their education up and empower them.
Yeah,
not going to happen by accident. And the schools and the universities are not going to do it. So now it's got to be within
for sure
the community that's there to help you. What are your basics regarding investing? What do you see as the foundation of sound investments?
Yeah, that's a great question. It's evolved for me over time. My first thing with investing, it actually for me starts with education. We talk investing a lot of times, we talk risk. And so my firm belief is for a newer investor, the number one risk is actually themselves, not knowing and not having the wherewithal to make good decisions. And so as you build on that, and we're talking now to a more sophisticated audience of, we start getting more education, we do start reaching for more sophisticated opportunities. And every step of the way, there's going to be new education that needs to happen. So I'm really big on that. When I look at the word investing, I'm very big on words and where they came from. Right. Okay. So I look at the word invest, the etymology, the derivation of that word, it actually means to clothe your capital. So I think about literally, I'm putting clothing on my money. If I put, if I take money, put it into real estate, the clothing is that real estate. And so when I look at clothing, just like normal clothing, right, I'm only going to wear things that I like. I'm only going to wear things that I understand. I'm only going to wear things that fit me as an individual, that fit the purposes I'm going to use them for. And then I'm going to wear the vital clothing before the non-vital clothing, right? I'm going to wear underwear before I wear a $300 Gucci belt, in other words. And I'm also not going to overpay. I'm not one that's going to probably spend $300 on a belt. Yeah, look at the price and the value. And so those are my tenets when I'm investing, is I always look at those 6 points. For me, the big foundation is I'm very big on real assets. So at the end of the day, if it's backed by something tangible, if it's backed by something real, to me, that has a lot of downside security where I know no matter what, that's going to be there. So those are kind of the main things that I like to look at. And I like to keep it simple too. My philosophy is if I can't draw it on a napkin and explain it like a 5-year-old, it probably isn't something I understand that well.
You sound like Warren Buffett.
Yeah, I've done some studying on Mr. Buffett. He's got some good insights.
Yeah, keep it simple. Know your domain of expertise at this point, and there's got to be real value, before we, actually go out there and buy. What challenges and pitfalls associated with creating and maintaining passive income, and how do we overcome them?
Yeah, this is a good one. So passive income is interesting because it's not, in my opinion, it's not an ultimatum. Like it's not. There's no such thing as entirely passive. There's going to be greater or lesser degrees. So you can get very, very passive. An example of that might be if I'm a private lender, right? If I do seller financing where I collect an interest payment, much like a bank would do on a mortgage, there's still going to be some level of oversight. I still need to check on things. I still need to look at statements. So I think that's one of the pitfalls. Is I think a lot of times we aren't quite sure what's meant by passive, and we think everyone means the same thing when they say that word. And so for me, I've realized not everyone has the same definition of that. So that's part of it. And then the other part of it too is, when we're looking at getting income that is passive, we have to look at the reason why. And I think when I look at it personally, it's a freedom thing. I don't want to have the obligation of trading time for money. Time for me represents action. It represents freedom. It represents ability. And so when I trade those things for money, I can't ever get those things back. I can get the money back. I can recreate it and reproduce it. So, I think a lot of times when people look at passive income, it's the dream of I want to retire and I want to be, I want to travel and go on the beach and et cetera. That's all great. But a lot of times that happens and we get bored and there's got to be another thing after. You can only, I live in Florida now, you can only go to the beach so many times. You see it and you're like, I know what sand and water looks like now. And so that's a pitfall. And then finally, I think, the other one is people getting involved in things that they think are passive and are not passive. And an example of this would be managing a rental property. That's a $400 a month part-time job, really. It's not that passive. And so I have to look at this and really, understand, again, what does passive mean? What is my purpose? What am I going to do with my time instead? And are these investments I'm getting into, truly helping me get there? And then realize I do still need to be active. The people that I know that have the most passive income, they're active with it. They look at it, they inspect it, they make sure things are okay. The income being classified as passive doesn't mean that I never inspect.
Yep, we find some of our fund investors and our listeners, they'll own 125 properties, and when you're looking at the property management, it'll reduce some of the burden, but again, they still need to meet with those individuals and walk the property with whoever's going to manage the property to make sure it meets their criteria and the upgrades that are going to take place and the additional rent that's going to be forthcoming as you make those improvements to the property. So we're also heading into what looks to be a recession. We're, in October of 2022. So we're going to move into some questions to try to help our listeners. Can you talk about private and alternative investments and leveraging opportunities that you recommend to your high net worth clients?
Yes. So one of my favorite things that I do personally is seller finance real estate. And this is typically with lower end homes. So a lot of times when I do this, it's going to be, I have a group that I go through for this, but we look at bank foreclosure lists. We're getting properties that are already at the bottom dollar, right? We're already getting a great deal on them. In that same stride, that does kind of make it recession proof. A $30,000 foreclosure home, there's not that much room for it to go down further, right? So we're able to kind of lock in a downside protection there. The reason I like this is because with seller finance, you're buying at one price, you're putting on market at another price. I might buy a home for $40,000. I might list it for, let's say, $60,000 or $70,000. The interest that I'm charging to that family that lives there is going to be based on the $70,000, not the $40,000, right? So I'm getting a yield as if I had put $70,000 into an investment when really I only put in $40,000 of my own principal. So I get an instant equity gain. I get a very high cap rate because of that. And then I also do get a real asset that does give me some downside protection. And it's, for me, that is one of the more passive forms of income. I'm not, if they break the toilet, I'm the mortgage. They've got to fix it. It's not something that goes back to my property management team or anything of that nature. So that's one that I like quite a bit. I'm also a very big fan of life settlement investing. Warren Buffett and Bill Gates are actually two of the bigger players in this space. It's usually more institutional, but we're seeing more and more opportunities with private equity funds and buying direct for the individual investor to start doing these. But this is great because it doesn't have any sort of correlation with markets, with the economy. It's based on an individual's lifespan. And so I can get a great internal rate of return. It's kind of insulated from some of these other factors. And I can really underwrite out the risk of going with an insurance company that's not solvent or isn't going to pay or might have exclusions. So that's another one that I like in my portfolio as well.
What do our listeners need to look at, or should they work through your fine organization for those type of opportunities? Because you'll do some of the due diligence that needs to be done.
So on the seller finance, my company can definitely help with that. We've partnered with a company called Equity and Help. You can check out their website. They're a great organization. They have a very strong team and they specialize in doing that seller finance market. What I like about their system is they buy the properties, they prehab them. So by the time I'm investing with it, minimum essential repairs are already done. And then they also put the family in it and manage the family and the relationship for me. So it's a very passive source with that. So that's a great one. And again, you can check out their site. We can also help out with that. On the life settlement, this one is really, you've got to find a good fund for it. So there are funds out there, not one that I particularly offer, but if you're interested in learning about it, Cliff, you might have some connections with that too in the life settlement space.
There's a whole life policy, could be a term policy that's sitting there, or a variable annuity, and now it's got value and you're accelerating the payments early, and there's a discount that's actually going to be earned by the investor. And then when that individual passes on at that point, you'll get you back your principal plus the upside, the differential between what you paid the individual for that policy. And I was really, really happy to hear that you said the solvency of the organization, meaning the underwriter, which is the insurance company, how strong are they to be able to weather what's taking place? And another resource for our listeners would be Weiss. Weiss's financial organization will rate these financial institutions. It could be a bank, insurance company, individual portfolios, ETFs. So just the idea that they're not taking any money from any of the rating companies, and they're doing the independent audit. So you can trust what's coming out of that organization. So they will be aggressive on their marketing. So I'm warning my listeners at this point, if you get on their email list, they're a little aggressive, but the material or the knowledge that's coming out of there is quality. Tell us, are there any assets that are more recession-proof than others?
There can be. For me, when I look at recession, typically speaking with assets, it's when value starts to meet with price, or maybe we want to say it the other way down, price starts to meet with value. So when we're in an overvalued market, that separation comes up much higher, and you see a high price. The intrinsic value might not match that price. And for a period of time, people are willing to pay that. Once that comes down, the question becomes, what is the actual value, right? And so, when I look at things, I do like to pay bottom dollar. When I buy gold and silver, I buy it wholesale, right? I want to cut out as much of that separation between price and value as I possibly can. When I do private lending and seller finance, that's another one where I'm going to look at, okay, I'm paying a wholesale price for the homes, even with the life settlement. So, the two that I kind of do stick with, even in a recession proof, and I mentioned this already, is the seller finance. That one is for me a very strong option. And also, the life settlements, gold and silver, and not so much of an investment, more of a store of value. Right? But that's another one where I do know I have an asset and I do hold an asset. And then I'm big on high early cash value whole life insurance as well. And that's also more of a savings tool than an investment, but that's a good place to store, because during a recession, we want to wait till it does get to the bottom. We do want to have some dry powder to go out and start making some acquisitions. And so it's a question of putting it somewhere that's going to give us, protection, liquidity, growth, and the ability to go use it when the time comes.
So your suggestion is, with the whole life, they can actually borrow on the policy at that point, and that's a tax-free, as you return those assets back to paying back that loan at this point.
Yeah, absolutely. Now, I do want to warn people, it does need to be structured very specifically. So if you go and talk to a whole life guy and say, hey, I want to go buy whole life insurance, he's going to rub his hands together and be very excited.
Worried about that.
So you want to look at a good way to model it is if you model it after bank-owned life insurance or corporate-owned life insurance. It's ultra high liquidity. An example of this would be if I were to put in $100,000, the very first day, I can go borrow, 90-95% of that. And that 100,000 will keep growing. No different than a home equity line of credit. The house can still appreciate even though I've taken a loan against the asset. So there is this particular structure for that.
How can our listeners make investments more tax efficient?
So this is planning, right? There are going to be investments that have tax advantages in and of themselves. An example of that being rental real estate. But the biggest thing that I see happen, when I talk to investors, is the taxes are an afterthought. They buy an asset and then they're like, this is great. It goes up in value, and then they sell it. And then they come to me and they're like, Jerry, I just sold this asset. I have a capital gain. I need to mitigate it. I'm like, great. Well, we should have talked about this 6 months ago, right? This is something that we can plan for now, but it's now slim pickings. It's more of an emergency. So I would say, being tax efficient with your investments does come down to proactive and strategic tax planning. And that's more of a matter of having the right tax team and having the right schedule with it too, right? So a lot of times we think tax season, which is, when we file, but that's tax filing season. Tax planning season, really, we're kind of in the thick of it now. Towards the end of the year, we should be looking at these things and making plans for the current year, but also making plans for the coming year with taxes. So there's great things you can do with, using charitable trusts. You can use self-directed pensions, self-directed retirement plans. You can do things like oil and gas drilling if you've got a good fund for that as well. There's tons of different tricks up the sleeve. It just comes down to what am I trying to accomplish and what makes sense at this time.
So you're really suggesting to our listeners, we really need to plan 3 years out, 5 years out, and put a strategic plan in place. And then you get to, on an annual basis, you're updating the plan. But you've got a sound strategic, let's just call it a financial plan in place, so there's no surprises and there's less stress.
Right. And on that note, Cliff, what I've realized too, as I've done more and more with tax planning, is sometimes the CPA isn't the tax planning. Like people have that misconception, like, oh, I have a CPA, and it's like, well, that's an accountant. And so they might do tax planning. More times than not, they're going to do filing, and they might do some accountancy stuff. But, for a tax planning, you really do need to have someone that specializes in that actual system of the Internal Revenue Code and what's out there. And oftentimes that's going to be in addition to maybe the person that does the filing and the record keeping. So
accounting will have the financial side and the consultative side. And you're looking at the expert that's on the consultative side that really understands the rules and regs and be compliant. And you can still have the benefits, but it needs that planning and the time to be able to execute. So you don't have the stress of trying to mitigate something that you just made a decision on. No, plan and execute.
Yeah, and on that note, I had a guy, this was 2 weeks ago. He sold his company for about 15 million.
Okay.
He sold it in March. And so he comes to me now, and it's like, okay, good. I need to mitigate my capital gains. And the first thing I thought was, okay, we could do a qualified opportunity zone fund, right? We can put that into the fund. At this point in time, he's got 2 weeks left because you've got 6 months to put that money into the fund, and it's been 5.5. So, these are the kind of things that we don't know till we know. And that's why it's so important to, have these conversations and have this kind of material out there, because someone like that might hear this line and be like, okay, good, I'm selling now. I need to get things in order before it happens.
At the pre-planning, very, very important.
Yeah.
Is there anything I haven't touched on that you would like to add?
I think on the legacy planning side, we really talked about, passing funds along. Before we started with the show today, we'd mentioned, kind of the younger audience. And I want to make sure we hit them because I am a younger guy and I'm a little bit of a unicorn in the sense that I'm doing well financially at the age I am. And so I can kind of relate to both sides. I think like an old person, but I look and act like a young person. So, especially for those that do have kids, they've got grandkids, making sure that the education is there, making sure that, things are set up where the legacy can be carried on. If we've got a trust and we want things to last generationally, the assets aren't the only things we want to pass down, right? The schools aren't doing it for us. The universities aren't doing it for us. And somebody that has built significant net worth, who better than that individual to teach their own kids and grandkids, here's how I did it. Right. So I think those are good conversations to have, even in your family estate plan. If you do a little write up of, here's what you should know, here's the basic tenets and principles and things that should be put in place with managing assets and building wealth and earning income and reducing taxes and, all those great things. And I think that's a great way to go about it and a good system to start with.
Today, we have video assets. So the idea of using your phone and talking into the phone and sharing your wisdom and how you got started in the life of the family and what you remember from your father and your grandfather and sharing that with the next gen is a very rich, dynamic conversation that it's part of your legacy. It doesn't take a lot of effort, but, once you're gone at that point, there's a vacuum of knowledge and people are making assumptions versus you articulating, this is what took place in my life. These are my feelings. This is the education I received. This is how we have the wealth. How do you want to look at philanthropy, building other businesses, employing, coworkers, team members. The success is not an accident. Somebody planned and executed. And I think that story, articulating it, is the most important part. Share your wisdom, with the next gen.
And I love that idea on the video. I mean, I just think about, Cliff, could you imagine if Sam Walton had video? Like the Walton children and the heirs, they're all on the Forbes list. They're all billionaires. But could you imagine if they had from Sam himself videos on here's how I did it?
Very different humbleness, from the
Yeah.
founder versus, the children are doing philanthropy. There's no question they're really passionate about it, but there's a very different. When you fly out to Bentonville, you'll see that there's some very, very large homes sitting there.
Mm.
In the earlier days, there was none of that. The high school looks like a university campus.
Mm.
It's okay. I mean, it is what it is.
Yeah.
It's just, it wasn't Sam's, thoughtful process at that point. And it's the heirs.
No.
Yeah. Changing topic. I'm addressing an important topic. As 95% of founders don't know how to sell their companies, I've co-founded with a global team at the Hyper Accelerator, a new market-leading mergers and acquisition accelerator program to help founders prepare to sell, merge their companies with our 100-day global virtual accelerator program. The M&A Hyper Accelerator will prepare portfolio companies to be acquired and maximize their exit value, integration, and life post-sale. You can learn more about the program at startupcourse.com and click on the M&A application. Again, that's visit startupcourse.com and click on the M&A application. I want to thank you so much for your time, Jerry. Your sound advice on investing is very beneficial for our listeners. And I want to thank you for sharing your vision and empowering the next gen to take an active role in getting financially educated. I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.